Okay, good morning, everyone, and hello from across Europe and North America. Thank you for joining us today at the Europe Disruptive Investment Summit. Today, we're here to talk with this panel to talk about assets on the blockchain. And when we refer to assets, they are real assets, they're hard assets, and certainly have a range from very simple things very simple things all the way to complex items. And I think what we want to have today is a little bit of a focus on the real estate and talking about how real estate interacts and works on the blockchain. This is going to be discussion based 40 minutes. We have assembled a great panel here with Jerome and Joachim, and we're going to ask them to introduce themselves in a minute. And just so you know, if you would like to have any questions, if you have any specific things, please put it in the chat. If it pops up and if it comes up at the right time, we'll certainly weave those questions into the discussion. Maybe Joachim, I can start with you. Introduce yourself. Tell us about what you've been up to, and please go ahead.
Yeah, sure. My name is Joachim. I'm the CEO of Jerome Capital. So it's a firm in the space that's done quite a lot of M&A. So we've been basically advising on sell-side mandates for crypto firms. We've also raised capital in traditional form for crypto companies out there. And another part of our project, also of our practice, revolves around token economics advisory. On the security token side, really, for us on this side of the pond in London, it's been early days. So our focus has really just been on kind of filtering and observing a lot of different projects. Like we have a couple of exchanges that are launching soon, Archax and Tokenize. And so we are gradually kind of lining ourselves up to work with those exchanges when they launch in due course. But in the meantime, we've just been kind of looking at a lot of different projects. We've done some capital structuring advisory, so we haven't focused on any placement activities, but we sort of looked at projects and gone through sort of the capital structure of those and seen how they can be improved or optimized. So also worked with some clients in the space who deal with the technical side of security tokens. And people who do invest in security tokens as well. So yeah, and we bring sort of more of a UK-based European perspective to space, which is sometimes a bit different from the North American perspective in terms of regulations. Actually, there is a little bit of disparity there. So anyhow, over to Jerome.
Hello, everyone. Basically, I'm a software developer. I've been in robotics for most of my career. And then I worked since 2017 in blockchain. So I started coding smart contracts then. Worked on DeFi before it was called DeFi, lending protocols, stablecoins, whatnot. Then I've been advising and working with exchanges and hedge funds for a while. And this year, since the bull market is back, was back, I've been working on a project called SingularityNet, on which we're basically building hedge funds on the blockchain. So manage portfolios on the blockchain mostly. That's mostly what I'm about to, and I'm mostly focused on smart contracts and how to make an idea become true with smart contracts.
Fantastic, thank you. So what we have here is a panel. We have with Jerome, who represents the technical side. Jerome is able to be the code. Jerome understands the inside technology of how assets actually get onto the blockchain. And of course, Joachim has a lot of experience about the regulatory framework around putting assets on the blockchain, and also has experience with called the tokenization of it, the investment perspective, and also the capital stack side. I'm going to take a moment to introduce myself. My name is Gavin. I represent a group called Richter, based in Canada, and in Canada, across Canada and the US. But we are business advisors. We have a capital arm, and we help individuals and organizations make the best collective decisions for their groups, their families, and their businesses. Among our practices, we have a technology practice, of course, but specific myself, I'm part of the lead of the real estate practice, which is a sector-specific practice helping businesses, organizations, and people make their real estate decisions. So what I want to do today is we're gonna talk a little bit about just defining what assets in a blockchain means, and then what we're going to do is maybe flow through what a transaction looks like. From the idea, from having an idea of putting an asset on a blockchain, how you actually do it, and what it means when you get there, and then what happens once it's on the blockchain. So maybe Jerome, I can start with you, and you can just define to us from the technical perspective, what does it mean to have an asset on the chain?
Right. I would start off with the main thing, which is that the blockchain is mostly meant to be decentralized. So the fact that we're removing any central authority into any transaction. So mostly the main idea of decentralization and the fact that you're validating a transaction as a part of a consensus of all the parties. So mostly the structure of that involves that that we're changing how ownership is transferred from one party to the other. So usually you would have a government or a central authority that says, well, ownership was transferred from that person to that person. That's the law. Currently, the blockchain allows to remove that party using a smart contract. So mostly a piece of code that is not staying in one place, but is basically staying in 33,000 computers for the Ethereum blockchain, for example. In that case, that piece of code will say that one party, which is represented by wallet address, is transferring the ownership of a contract to another wallet address, and that will be stored in the smart contract. So the way you would actually put an actual asset from the real world into this smart contract is the tricky part. Smart contracts are very lightweight in terms of ability to hold data. So you cannot be very complex in the type of information that you will store in the smart contract itself. So in the case of NFTs, for example, what you would do is so NFTs are, and I'm guessing everyone knows what NFTs are. It's been in the news. But basically, what you would do is you put the address of a server which has metadatas. Those metadatas will have all the information, like let's say the image, the author, the description, and whatnot. So all the enriched informations that you cannot actually store on the smart contract. And then once you transfer the ownership of a smart contract, of that smart contract, then the information of what was transferred comes along. So I mean, that would be the technical side of it. I mean, I guess I could expand more. Yeah.
No, that's great. So just in summary, so you have this distributed ledger. You have the information, you've metadata and information about the physical asset that's stored on the blockchain, but then you still have the idea of the physical asset exists in the real world. You obviously can't place that directly. Now, Joachim, may I ask you from the investment perspective, when you have this data, this metadata, the digital description, if you will, of the hard asset on the blockchain, and you're an investor and you're trying to get hold of that asset, you're the next owner of it. How do you view the integrity of the information on the blockchain, and how do you link that to the real asset? Joachim, you're on mute. Maybe you can just adjust your computer.
Yeah, so ultimately, boils down to is whether or not the smart contracts constitute legal contracts in the jurisdiction you're operating. So there's certain places, let's say Italy, Switzerland, etc., where smart contracts are deemed to be legal contracts, but in most countries they're not. So although you do have a smart contract and an on-chain transaction, you still need to also have the exchange of physical paperwork or some form of settlement that happens off-chain as well, and that brings about a number of complexities. There are also some specific complexities that around smart contracts and specifically securities, where if a security is held within a smart contract, it can be quite problematic, specifically in the US at the moment. So it's not straightforward. In the case of an asset that is a digital asset, in a way, it's not very controversial. Even whether the smart contract is a legal contract or not, that digital asset does get transferred. It wouldn't get challenged. But in the case of a physical asset, it's a different story. So that's why we found that quite a lot of projects, ultimately when they talk to investors, quite a lot of investors really want for issuers that do link smart contracts to physical assets to be based in countries where smart contracts are actually recognized, as legal contracts.
Right. So it sounds like, right now where we are with technology, and more specifically from the regulatory front, is that we're using a parallel process. We're using that's called the traditional paper-based project to effect or legally transfer assets, and let's take real estate for specifics.
Yeah.
And then you're using the blockchain to almost mirror that, or to record that paper-based transaction and store as much information as possible. Jerome, maybe I can talk to you now about the smart contract that does affect the real asset transaction. Can you talk to us about the limitations of the information that can be put on these smart contracts, and what are the fields that can be used, and what are some of the shortcomings right now with the technology, specifically with the real asset world data that you may need to connect with it?
Right. Well, I'd say when we actually start with the fact that even in the digital side of things, for in the main example, as for NFTs or digital assets, you still need. You don't really have the ownership, because basically mostly, at least on the current standards, we're redirecting to our off-chain sources like a server. So let's say, if you're familiar with the Beeple painting, which was a digital asset, everything is stored on a server, and so the smart contract points to the server. If, for example, I was to make a server attack and destroy the server, then the digital asset that was linked to the smart contract doesn't exist anymore. So you basically only own a smart contract, but you don't own any piece of art. So that's kind of the first problem you would get. So let's say in the case of real estate, I transfer you the ownership of a building, but that building gets bombed because it's like in a war zone or something. Then there is no actual asset connected to the smart contract. So you transfer ownership of something that doesn't exist. So how do you actually account for the actual? So you still need a party that will validate whether or not there is an actual asset that's been transferred and that the actual asset is well transferred. I'd say another case we would give is, for example, if I was to transfer, let's say I'm buying Mona Lisa, and I'm getting a smart contract that shows the ownership of Mona Lisa, and I'm transferring and so I'm getting the actual piece of art, Mona Lisa itself, but then I'm selling it to someone else. on the blockchain. So I'm transferring the ownership, but the actual Mona Lisa copy. So I make a copy of Mona Lisa and I transfer a fake Mona Lisa to the new owner. What does the person owns, the real Mona Lisa or a fake one? If the ownership defines the actual asset, then the fake Mona Lisa becomes the real Mona Lisa, and the real Mona Lisa is not a real Mona Lisa anymore. So you get some issues there, and it's an open discussion.
That's an absolutely fascinating concept, Jerome, to say that, what you have is you have a hard asset that someone has ownership of. They record that hard asset on the blockchain. Hopefully there's a way you can mirror the paper-based process to the digital process. Now you transfer that digital asset, but you now transfer a copy or the incorrect hard asset. And now what you've done is you've linked the true ownership of the digital asset, which was originally linked to an original hard asset, to a replica of that hard asset. And maybe then that changes, in at least the digital world, it could change the definition of which one is the true or the original. Of course, this opens up a whole nother world of complexity and complication. And maybe, Joachim, maybe you can give us some insight on, if you're now a buyer of a hard asset through the blockchain, how do you diligence some of this? How do you diligence the authenticity? And is there another process or avenue or technologies you can use that are based on the blockchain to diligence it, or are you relying on more traditional methods?
The reality is that, from what I've seen so far, there's some good examples of potential issuers who are looking to tokenization of assets that are typically very difficult to bring to market, like very large precious stones or very valuable paintings, and obviously looking to then fractionalize those. And those assets, will be sitting presumably in a vault somewhere, let's say in a vault in Switzerland. So the question is like, how can you be certain that the asset is actually there? And as you said, you have to rely on traditional methods, real due diligence. You need specialists who fly there to basically ascertain the authenticity, issue certificates, and then also issue the certificates on the blockchain. But as you can imagine, you then need periodic audits as well. So you actually need, again, like every year or whatever period it is, you need for some expert to actually access the physical object, make sure it's there, make sure it's the same object, issue a new certificate. So there are no shortcuts in terms of ascertaining ownership, because unless you can imagine like how technology can enable that. I mean, let's say that you have a live camera feed, that actually constantly records the presence of a physical object in the vault,
right?
And you see like the certification process, and then the camera feed is kept live, it's stored on the blockchain, it's uninterrupted. Something like that could possibly kind of lessen the need for like ongoing certification, but yeah, it's a manual process.
So it sounds like, yes, so it's a manual process. You have this extra layer of, call it, recording and authenticity, and it's really up to the new owners or the buyers to do their typical diligence investigation. But now they've got a physical world investigation plus a digital world investigation. And do you see, is there a new crop of service providers or firms that are coming up that are starting to bridge this divide by physical and digital diligence, or are we still early days?
It's really early days still. There are some new interesting projects that are looking at, for instance, on-chain certification of diamonds. So you have on precious stones. So you've got basically a laser inscribed sort of code or hash in the diamond itself, and then you've got a cryptographic hash that sort of mirrors that laser inscription on chain. And so those certification processes are sort of, are actually a very good use case for blockchain. But it is, you don't yet have, let me correct that. You actually do have now some companies, specifically like in the fashion industry, that are spending a lot of money on sort of establishing certification processes for high-end luxury goods, like handbags and shoes, and that costs thousands of dollars sometimes, specifically to kind of weed out fake goods in the market. So that is coming. It's becoming mainstream, but it hasn't yet become super mainstream yet.
Right. It's amazing how much extra work, as these new technologies unfold, it's obviously, it changes the game, and you have to be able to live in both the physical and the digital world now, in order to make sure that you're truly covered in what your investment, your purchase is. Maybe Jerome, I can ask you if you can just elaborate on the NFT world. We know that the NFTs are starting to take off quite clearly. There's obviously a technology behind them that is being adopted. Can you comment on is it the same technology, the same process that we would use, or we can extend to the real asset world? Maybe you can pick up on the
of course. Yeah, I'd say the main technology, NFT stands for non-fungible tokens. So basically, the main idea is that there is only one token in the entire blockchain that is represented by the token. So there is no way you can have two NFTs which have the same identity. So usually it's called a unique identifier, an ID. And so that, if you were to generate that unique identifier from the real assets using informations, so basically code into the blockchain informations which are basically traits of the hard and physical asset, then you would definitely have the representation of the real asset onto the blockchain. It would not be tampered with. So let's say it's a hash, and from that hash you generate the NFT. So it's quite complex to define, and it's a lot of research at the moment, I'd say, to say that, and also you would probably need another type of blockchain than the Ethereum blockchain for the moment, because it's not built in. But it's a lot of research to actually define what would qualify the unique identifier from physical assets, like the size, the shape, whatnot. All these information could be onto that one information that cannot be tampered with. So I'd say that would be an answer. But right now, NFTs are mostly links to a website. Right. So the main issue is that you would go on Google Image, and Google Image is actually a better technology than NFTs at the moment, when it comes for images, because at least on Google Image, you can actually qualify the rights of ownership of that specific image amongst all the images on the internet. An NFT, I can take a screenshot of Mona Lisa, even on the Louvre website, and put it on an NFT, and I can sell it as being the real Mona Lisa. There is nothing preventing me from doing it. So that's the issue with NFTs at the moment. The technology doesn't fit as much. The idea of unique ownership, especially for digital assets, because you can make any digital asset and link it. So that's kind of the issue at the moment. There are a lot of research. People have been taking on the NFTs much more than 2017. Just like for other type of products, but NFTs right now, there are a lot of use cases which are not explored, and the technology is not to the level where it should be. But there is a use case, for example, for identity that could be interesting. There are a lot of innovations with the idea of having only one identification onto the blockchain.
Thanks, Jerome, for that. So yeah, you picked up on I want to transition the conversation on the use case conversation more particularly to the hard assets, and maybe Joachim, I can ask you, when you think about a use case, the correct application of putting an asset or a hard asset on the blockchain, what are the attributes of that asset that one would assess to see whether it is a correct application? And then maybe we can extend that conversation to how is that assessment of a real estate asset put down, so you can assess that its viability to reside on the blockchain.
Yeah. So look, I think there's a difference between like fractionalization, the blockchain itself, because you can fractionalize an asset without blockchain. Frankly, it's entirely possible. It's been done before. It's not a problem. It's more a question of like in what cases is it cost effective to actually put specific assets on chain, and what does it bring to business or a project. And like in the case of real estate, obviously, what fractionalizing real estate and putting it on chain will mean, once all the infrastructure is there, is effectively people will have access to invest in real estate. The barriers to entry will be a lot lower. So instead of having to buy, a single piece of real estate, put together my own real estate portfolio where I have like 3 houses and 2 flats, I'll be able to hold, fractions of real estate, in a much better diversified portfolio. I mean, that's really ultimately the use case. Now, how would you assess whether that real estate is fit to be put on blockchain? Well, first of all, I guess the first barrier is you have to make sure that to understand what you're tokenizing. So are you tokenizing the actual real estate, or are you tokenizing, something else, i.e., let's say a special purpose vehicle that holds the real estate and the income from the real estate? Right. Those two things are quite different. But
so the distinction there is you're actually taking the asset and putting that on the blockchain versus I'm taking a share of a corporation or a limited partnership or some entity that ultimately owns the real estate and putting it on there.
That's correct. So you have to define what you want to do. But once you define that, you have to look at what are the market standards for real estate. Because obviously, like, it might be tempting for an issuer or someone who builds real estate to try to find like financing sources that are, easier to access, cheaper, etc. But the problem is that, the real estate market is already well developed. It's quite, and actually, like, most of the pricing, is quite optimal already in terms of how, sophisticated investors look at capital structures, how they look at investing. And so it's very important to realize that there's very little opportunity for arbitrage to actually change prevailing capital structures when you move things to the blockchain. And there's always a trade-off. So giving you examples, so if, let's say, you want to make security out of the income stream, the rental income stream of, let's say, an apartment block, and you want to distribute that security to investors, and you need to realize that actually tokenizing the revenues does need to come with certain investor rights, for instance, to balance out the fact that you are only tokenizing revenues. So what we find a lot is when we look at capital structures is that there's a little bit of wishful thinking around how people want to like raise capital. They want to raise capital cheaply. They want to raise capital on terms that wouldn't be possible in the traditional securities world. So I think it's very important to understand that for this sector to really take off and gain mass adoption, there needs to be a lot more work done around the educating issuers that capital structures are kind of the mathematics and the math behind capital structures and financial returns is unchanged. Technology has changed nothing there. All that you have is new technology, which brings a lot of benefits, but it doesn't change the math behind the financing.
Absolutely not. So, and maybe that's a good lead into the next topic. And this is aimed at Jerome. Is, you have the introduction of new technology. You've talked about what the appropriate use case may be for it or may not be. And I imagine there's a race between what people envision they want to get to and where the technology is. Sometimes the technology leads what people are thinking, and they have to find ways of utilizing that technology. And sometimes the technology actually lags where people want to be or what they envision from this. Specifically with respect to putting assets on the blockchain, is the technology leading right now, or do we have too much technology for it, or is the imagination of how this is ultimately going to prove out, or is the technology lagging that, and is there a technological gap for the intern?
I mean, it's always been a topic about technology. I mean, can we go to Mars at the moment? No. Will we get to Mars at some point? Yes. So I'd say right now it's there is no problem in having a lot of capital and imagination into the space. I mean, that's what's fueling new ideas. But right now, I mean, definitely, I'd say, especially into putting real assets, I think it's more about understanding how you can have this back and forth between the blockchain and the real assets, being able to track, I mean, the different topics we've been discussing. But I have no doubt, I mean, especially in that space, I mean, I've been there for a while, and we always found ways to solve the problems. Obviously, I mean, there is a lot of marketing, there is a lot of statements being made, and things which are not possible being said. That said, it's not. There's still. It's not impossible, and there's different leads being made into actually connecting both. I mean, if you look at the space, for example, in what's called the supply chain, usually you have processes which are very close to how you would track and connect the data that is being stored to tracking the transfer of ownership or this kind of elements. So I mean, it's yeah, it was the I just heard the sound. But yeah, I mean, my take is technology is evolving. It's not too. I'd say it does whatever we will say to it to do. It's a great tool, but we're not. We have to create the right processes for things to last, for sure.
Understood. Just mindful of time here. I just want to fast forward the topics. Joachim, we chatted previously about some of the challenges that we find around putting hard assets or mirroring hard assets in the blockchain. Is there anything you can comment about the evolution of the regulatory environment? What are the big challenges now, and what do you think we're going to be seeing? How is it going to be evolving over the next little while?
Well, I think a big step will be when more and more jurisdictions sort of accept on-chain settlement, because that should have the potential to really sort of revolutionize how businesses and banks and fintechs deal with, let's say, loans. I mean, you can already do on-chain settlements of individual loans, but more around securities. Because that will really make OTC transactions so much more efficient. At the moment that's an enormous market, and it's still operating on like old school paperwork. So on-chain settlement will be a huge thing. I think regulators are making moves towards like at least sandbox environments where there's experimentation with this. And it will happen at some point, but yeah, I think we're still a couple of years away from that.
Absolutely. We're going to come to the end of this panel. Jerome, I want to give you an opportunity just to talk about some of your current projects, maybe allow people to know where to find you, and then there'll be one concluding question after that. So why don't you go ahead, Jerome?
Sure. Yeah, I mean, currently working as a blockchain developer on Singularity DAO. So basically hedge funds on the blockchain. So you can get you can invest in a basket of different assets, mostly tokens. So you can get exposure to different assets and strategies by buying one piece of the fund. So you can, mostly you would find us on Uniswap. So our ticker is SDAO. And so basically I'm currently working on the project and trying to make sure that it grows.
Fantastic. Fantastic. And Joachim, maybe you can tell us where people can find you and what you've been up to most recently.
Yeah, so it's been busy days, lots of projects. I guess, we've been working across some sort of M&A mandates I can't comment about really, but I think one thing that we recently closed was actually the direct dual listing of QBTC, the Bitcoin fund on Nasdaq Dubai. So which was a big move because it's the first time you have an actual Bitcoin fund that gets direct dual listing on a major international exchange. So it's listed on TSX, and it's also now listed on Nasdaq Dubai. So it's the world's first. And yeah, so you can find us at 01.capital, ZERO1.capital. Happy to sort of discuss, complex projects and challenging assignments.
Fantastic, thank you. Just as a reminder, I represent a company called Richter. You can find us at richter.ca, RICHTER.ca. There's lots of professionals and organizations and advisory and strategic advice on there. So please look us up there. Last closing question, Jerome, I'll start with you. With any technological advancement and the adoption of it, there are always going to be some entities that are going to benefit, and there are going to be some entities and players that are, their businesses are going to dissipate or be challenged. Thinking about it from the dollars or revenue perspective, maybe you can just give a very brief list of who you think are going to be the winners and some of the players that are going to be challenged going forward.
I mean, recently I saw a message saying basically, blockchain and cryptos are going to be the same type of change that you would see that emails did to mailboxes. So definitely, cryptocurrencies are going to challenge main institutions, namely banks. Which was not heard of in the last couple of centuries, let's say. So that's the challenge. Then, but it's really about the responsibility of people in cryptos and the blockchain about making something better than what banks were doing. Otherwise, it will probably be worse. So I'm actually calling for responsibility and vision throughout the entire blockchain community into making a better world, because that's why we are here for, actually, not making it worse.
Fantastic, thank you, Jerome. And Joachim, you have the last word. I'm sorry we didn't have time for any more discussion or Q&A, but Joachim, who are going to be some of the beneficiaries and who are going to be some of the challenge entities going forward based on this technology, putting assets on the chain?
Well, I think generally, with blockchain, again, it's one of those technologies that's going to actually, basically really disrupt, and what does this disrupt mean? It does mean displacing a lot of existing jobs, making, reducing the burden of administration and so on. But it also means that, the economy will now tilt again towards, a different job market. People will need to have different skill sets and so on and so forth. So I think, the beneficiaries will be those who, as usual, are willing to adapt and who sort of are open to change, and see the potential of the technology. You know, I think as Jerome alluded to, I think like banks who continue to run a completely traditional business model, you know, might not survive, because it is a very old business model. But I think there will be banks that are quite forward-looking, you know, and fintechs and financial institutions that, you know, based on what I'm seeing in the market, you know, and some big moves that these guys are making, I think they will adapt well to blockchain and play an important role.
Fantastic. Well, thank you to the Summit for having the three of us on here on the panel. Joachim and Jerome, I appreciate your insight, and it's very nice speaking to you today. Have a good afternoon or morning, everyone, depending on what time zone you're in. Bye now.
Thank you very much. Thanks, guys.
Right.